Everyone. Thank you for joining our webinar today. My name is Winnie Murugi, Tax Manager at Grant Thornton. I would like to take this opportunity to welcome you all to this interactive session as we engage our experts on matters of tax and in particular key changes that came into play with the enactment of the Finance Act 2023 and how these changes are going to affect your businesses going forward. Finance Bill 2023 was assented into law on the 26th of June 2023. That is following successful debates in the Parliament. There were also public participations, which is required by law, and this gave the public an opportunity to voice their opinion and give proposed amendments to the tax laws. As Grant Thornton, we also had the privilege to submit and present our proposed amendments to the committee, and majority of these proposals were actually adopted, among them being the zero rating of export of services, LPG, fertilizer, reduction of withholding tax rate on digital content creators, increase of time taken to remit withholding tax, among others. As we proceed, I'd also like to point out that there has been a petition to the High Court, as you may have seen in the media, which was presented by Okiya Omtata, that sought to have the High Court issue a temporary order that suspends the implementation of Finance Act 2023, which I need to mention that the High Court actually granted. So two of the major contentious and controversial issues that led to this petition were the housing levy and, of course, the 16% of fuel, which I'm sure, as you've seen at many fuel stations, the prices have been affected to accommodate the 16% charge. However, we do expect the directions from the court today. As we speak, there's a hearing that is going on, and we are going to have a determination as to whether this stay will continue. So we expect to have a determination before close of meeting today. And if probably this will be done before the end of the session, we'll definitely ensure that we highlight that. A key look at numbers with regards to the national budget for 2023-2024. As you can see, the revenue projection for 2024 is at 2.9 trillion, which is a growth from 2.6 trillion of last year. In terms of the total expenditure estimates, as you can see, is 4.45 trillion, which is a gain of 8.5% from 4.1 trillion. In terms of the revenue contribution from taxes, what we expect KRA to contribute to this budget, we have about 2.57 trillion, which is a rise again of 14.2% from 2.1 trillion of last year. Looking at that, then there is a budget deficit of about 0.3% at 1.5 trillion compared to 1.509 trillion of last year. Again, looking at the statistics currently in Kenya, in terms of the leading tax sources for 2024, in income tax contributes to 46.6% revenue contribution. VAT contributes to about 27%, excise duty about 37.7%, import duty 6.7%, while other duties and taxes contributes to about 4.3%. I mean, these are the numbers which are presented to us on the national budget for 2023-2024. I don't know from where you're seeing this platform, is it good or is it bad? I think I leave this to you to answer so that we can look at where we are going into, as a country. As I conclude, I'd like to mention that we did share a detailed tax alert on these tax changes, and what our presenters will be talking about today is basically a summary version of what we shared with you. In case you may not have received it, kindly notify us on the emails provided so that at least we can share that along with the presentation slides once we are done. I'd like to encourage all of you to kindly share your questions or comments with regards to this presentation on the chat box, and we'll be able to address those as the presentation continues. Without much ado, allow me to welcome our first speaker of today, Mr. Mbiki Kamanjiri, who will take us through the key changes in income tax and VAT. Over to you, Mbiki.
Thank you, Winnie, for that good introduction. And I guess that it pretty much sets the base for where the country is operating at from. And so like Winnie mentioned, I shall be covering income tax changes from the Finance Act. and VAT. Then later on, Samuel will be joining to take over the other taxes and also the procedural changes. So yes, very quickly into this. When you're doing your tax computation for next year, a key point you need to note is that the only expenses which will be allowed for deduction against your taxable income will be those expenses for which are supported by either an eTIMS or a TIMS invoice. KRA has really been trying to get everyone onboarded on this. We've actually got a notification that they've already started blocking pins for people who are VAT registered and have not yet taken up the TIMS or TIMS machines. So I think for most of you, probably you should start at least getting in the practice of this. And what we're most likely to see from this is a lot of the small traders are going to be crowded out, in that most businesses will prefer to deal with persons who have these proper invoices raised from the eTIMS and the TIMS. And just to demonstrate how serious the government is, the penalty for non-compliance with the electronic tax system has been increased tenfold to either higher of 1 million or the 10 times of the tax in regard to those invoices. So on the other issue, the Finance Act of 2021, there was a change in application of the thin capitalization rules. And so now currently what we were looking at, especially for last year's tax computations, is that if your interest expense is in excess of your EBITDA, and that is the earnings before interest, tax, depreciation, and amortization, if that expense exceeds 30% of your EBITDA, then a number of restrictions would come into play. The first and foremost would be in that your Forex losses from those loans would be restricted, rather deferred. And secondly, also that interest would also not be allowed in your tax computation. So especially with a lot of input from players and also through the public sector participation, there was a lot of lobbying for us to see some change in this. So through the Finance Act, the first issue that is coming out is that there'll be a limitation for the period for which the foreign exchange losses can be claimed, and this is up to 5 years. And then I think the most important one is that the definition of all loans. So in last year, definition of all loans covered also loans which were sourced locally. But through the changes from the Finance Act 2023, this will now only be applicable from non-resident loans. So if you sourced your loans from a non-resident person, that's the interest that is going to be restricted, and that is also the Forex losses which are also going to be restricted. There was still a bit more push in that we're hoping to see that the definition of all loans would cover specifically your related parties, especially those who are non-resident. And the idea behind this is because these provisions were put in line with the BEPS action plans to try and avoid cases of base erosion. And the argument that we were giving is that, look, resident loans would not be really used to shift tax profits, and especially for those people who probably be able to source loans from non-residents who are not related parties, then in that case, you'd also not be using such to shift your profits before taxation. Another change that we're seeing is that the exemptions for manufacturers whose investment is above 5 billion over 5 years has also been removed. So more on the changes on corporation income tax. For branches, these have previously been taxed at the rate of 37.5. There is now a change that branch entities, or rather what we call permanent establishments, will now be taxed at 30%. However, when they repatriate profits, these are now going to be taxed at 15%. And there's also a formula that has been given at how you're going to arrive at those repatriated profits. However, what we're seeing from that formula is that in some cases, you might get some clawing back of benefits that had been given to you, for instance, accelerated deductions from your capital investments. Another change also from this area is that now branches will be allowed for deduction of expenses which are incurred outside of Kenya. Member clubs and trade associations are now taxable, especially from income that is not from membership joining fees. Previously, the only taxable where their income was equivalent or more than 75% from member contribution. Another change that has also seen quite a lot of discussion on social media and the public scene is that turnover tax rate has been increased from 1% to 3%. And also the threshold has been slimmed down. Before it was for any players, rather businesses who had revenues from 1 million all the way to 50 million. Now this has been capped at 25 million. So the businesses which had already joined on the turnover tax regime and they have revenues above 25 million, they'll now have to come back to the regular 30% regime. And the idea behind this was we've been told that the 1% was given to cushion people as part of the COVID measures that we saw in 2020. And it's the feeling of the government that these businesses have since recovered and stabilized in a sense, so something which is yet to be seen, and hence why now being taxed at 3%. Also, the other idea was just to try and net a lot of these businesses who were not paying taxes, and the idea was that turnover tax is a much simpler regime, and especially that you didn't have to have audited financial statements, especially within that threshold. On the manufacturing scene, local content has been defined for motor vehicle assemblers. So for you to be able to take advantage of this reduced rate of 15%, you need to have at least 50% of your inputs being local content from an original equipment manufacturer who is also operating within Kenya. Then another expansion in terms of the benefits in terms of reduced corporation tax rates, manufacturing entities and refining entities have also been included into the special operating framework arrangement if you have an investment of at least 10 billion. So this was previously only being enjoyed by people manufacturing human vaccines, but now this is being expanded, and also for a raft of benefits, including VAT, which is generated for persons who qualify for this. And under the special operating framework, that is the in short form, the SOFA arrangement, you get reduced rates based on how well you're able to negotiate your case. So I think some of the added benefits is that for residential rental income tax, this has been reduced to 7.5 from 10%, which was the previous rate. And another benefit is that this is also a final tax. Now, the MRI, that's the monthly residential income tax regime, was introduced to try and attract landlords. These were also the previously so-called hard to tax areas. A lot of landlords were not complying with the taxes. So the commissioner introduced this lower and probably simpler regime in a bid to try and attract more people. There was also a special project around residential rental income set up in KRA, which was unceremoniously disbanded. Seemingly, they were not able to fully actualize their mandate. And probably this is also why we're seeing this rate being lowered further. Withholding tax also for the withholding tax agent, the rate has also been reduced just to equalize this. And also now the commissioner has been given powers to appoint withholding tax agents from the real estate agents, the persons who are usually contracted to collect rent on behalf of landlords. When the commissioner deems it fit, so we're going to say probably the likes of Lloyd Masika being appointed as such. Another interesting area that has also garnered quite a lot of discussion, especially on social media, is the digital content monetization issue. So there's going to be withholding tax on this, and government pretty much realized that the Kenyan youth who are participating in content creation, they're gaining quite a lot of revenues from these activities. And actually, it's been pointed out that online digital content creation is currently the fastest growing area in terms of the advertising industry. So this is something that KRA is really keen on tapping as a new revenue stream. So some of this would have fallen within the bracket of the normal withholding tax. But I guess also just to clarify, especially to the people who are making payments for this, a new withholding tax has been introduced at 5%. Initially, the finance bill had proposed a rate of 15%, but I guess also through the public participation process, this has been reduced to 5% to be equal to the other professional services. Another one that has also been introduced is the digital asset tax, which is going to be applied at a rate of 3% of the transfer of or exchange value. So the Finance Act also defines the digital assets as anything of value that is not tangible and held in a digital form. So this will be the likes of the cryptocurrencies, the NFTs, which we saw rising to fame, especially in the past 3 years. So anyone who is offering a platform that allows the exchange of these digital assets, they'll be required to withhold 3% tax on the exchange value. And I think probably also some more clarification that we're looking on this is whether this is going to serve as a final tax or it's going to be an advanced tax, such that the persons who are trading in such will later on have to now account for the rest of their income that they have gained from taking part in trading of such assets, and then also allowed expenses which they have incurred in creating, rather transferring these assets. And also something else that's around this is, if you look at most of the trading that happens around this area, a lot of it has very slim margins. So a tax at 3% of the exchange value does not take into account that in some of the cases, you might actually be making losses on when you're transferring these assets. So those are some of the clarification that we're looking at, and especially with the question that a lot of this could have easily been covered within the capital gains tax regime. So probably what would have been looking at is maybe some form of investor education, such that educate the persons who are trading in this area and probably have them accounting for their taxes through the capital gains tax regime. So more on the administrative changes, withholding tax previously, we used to make sure that whatever has been deducted is paid on or before 20th of the following month in which the deduction was made. But now with the Finance Act changes, you will be required to make that payment within 5 working days. And so what we're seeing around this is there's going to be quite a lot of administrative issues just for you to be able to comply with these new requirements. And probably for some of the businesses, rather the large companies who have quite a number of transactions which involve withholding tax, you might find yourselves having to employ a resource just to take care of your withholding tax, such that you're not being hit with the penalties for non-compliance. And remember, we've also seen the recent ruling from the Court of Appeal, where the term paid was defined to include accrual. So in cases where you've actually not yet paid your supply of the professional services or any service that attracts withholding tax, but you have accrued that expense within your books, should KRA come and audit you, they will consider the date earlier of actual payment or accrual to be the payment date. So we're going to see quite a number of administrative challenges around this just to make sure that taxpayers are compliant with this new requirement. A new inclusion into the withholding tax regime. We're also now going to see sales, promotion, and marketing and advertising services falling within the normal professional services. So whenever you're paying your suppliers for any of these services, you will now be required to withhold 5% if the supplier is resident and 20% from non-residents. And again, remember, once you make that payment and the deduction, that withholding tax should be paid on or before 5 working days. So over on the transfer pricing side, so what we've seen, especially in the recent past, whenever you had transfer pricing adjustments, especially in the area of management fees or royalty payments that have been paid to your non-resident related parties. If KRA comes, audits you, and they find that these expenses, that's the management fees or the royalty fees, they were excessive, and they make an adjustment that is reducing that amount, but what they feel should have been the arm's length price, you will now no longer be allowed a credit for that withholding tax that was already deducted when you're making the payment. So for instance, you made management fee payments or royalty payments to your related party in Nigeria, for whom we don't have double taxation agreement. So the rate is 20%. KRA comes and says those management fees were excessive, sorry. So they will disallow that expense, meaning now you'll have to pay 30% on it, and they're not allowing you that 20% credit, which you already paid in terms of withholding tax. So in our opinion, this is a bit of an unfair move because now you're paying tax twice on this same expense. On the country by country reporting, which came into play as from last year, we've seen a bit more clarifications around this, in that it's been clarified that the ultimate parent entity who is resident in Kenya and has revenues of above 95 billion shillings, they're the ones who will be required to file the country by country reporting, which is due by 12 months. So if you're a December year end, by December of this year. We're also waiting for the template, or rather the format, for how the country by country reporting will be done. So we have been promised that this should be with us by either, that is next month, but at least before the end of September. The other option is that if you're a constituent entity and your ultimate parent entity in their jurisdiction where they're resident, they're not required to file the country by country reporting, and they have reached that 95 billion shilling threshold, then in that case, that's when the constituent entity will be required to file this CBC report. Now, for such discussions, we have a very vibrant team of TP experts who would be willing to engage you. So if at all you got lost by those terms, the ultimate parent entity, do reach out to us. We have a very good team that is currently handling this for some of our clients and would be more than happy to assist. Indirect transfers of shares will now be subject to CGT if the ultimate beneficial owner changes by 20%, even if they're not resident in the country. Then for any persons who have gotten exemptions from CGT within a restructuring transaction, if there's a subsequent transfer within 5 years, and there was a rebasing within which the transfer value had been done, then if it is within 5 years, then there might be some, rather not might be, but there will be some clawback if this transfer is now again to a third party, a clawback of some of those benefits which you got from that exemption. Another issue that has been really discussed is due date has been clarified. The due date for payment of CGT, that's capital gains tax, will be the earlier of receipt of full purchase price or registration of transfer. The current due date as per, rather the prevailing due date as per the Income Tax Act was deemed to be unconstitutional. That was by the High Court in 2017. So this is a welcome definition, or rather clarification. However, we're still going maybe to see a few issues, especially in the case where you might find some hitches at the lands registry, and probably you might not be able to register the transfer, even if the full purchase price has already been paid. Another restriction on CGT, if you are going to get the exemption on restructuring, this will only be exempt if the transfer is not to a third party and it is for an entity within your group that has existed for at least 24 months. That's 2 years. And the idea behind this is, I think the commissioner noticed that quite a number of taxpayers who are taking advantage of this provision, such that you form an entity fully owned by the company just to transfer assets, and with the idea of getting some of these exemptions provided in the Income Tax Act. For advanced tax, we're going to see an increase in rate from the current 2,400 per annum to now 5,000 shillings per annum. And I guess maybe the issue that we've seen many people asking is this applicable to all vehicles? No, it is not. This will only be applicable to vehicles registered as commercial vehicles. And then finally on personal tax, rather still under the income tax, there's the increase in, rather, we have now two new tax bands at 32.5% and 35.5% for incomes greater than 500,000 shillings and 800,000 shillings respectively per month. And I guess maybe the question we're asking this, because given with the numbers that the CS for Treasury gave us, if you look at the taxes which are going to be collected from these increases, it begs the benefit, rather the increase in revenues. Is it worth getting this branding that Kenya now taxes income tax at 35%? Because for most people who are not resident or who are not Kenyans, they'll just see that 35% tax rate without really looking at from which bands does it apply. So, but yes, this has sailed through probably and is going to be here to stay with us. Another clarification is that for you who get reimbursed on mileage claims, if your employer is using the AA rates, then this is not going to be a taxable claim to the employee. I guess from practice, this has been what has been used, but at least now we have the clarification being embedded in the Income Tax Act. Another clarification is that club entrance and subscriptions are now deductible for the employer if they have been taxed on the employee. However, if it's not taxed on the employee, then this will be a disallowable expense for the employer in the tax computation come the end of the year. And also, welcome addition is that we now have the post-retirement medical fund relief, which is going to be applicable at the lower of 15% of the premium or 60,000 shillings per annum. So quickly, let's look at some of the changes on VAT. When you're deducting, rather, when you're claiming your input VAT, currently you're required to be in possession of a valid tax invoice or having ensured that the supplier has declared that sale invoice in their return. However, now the Finance Act brought in a change in that in between these requirements, there was the word or. This has now been deleted and replaced with the word and. So what this means is that you'll be required to be in possession of a valid tax invoice generated from an eTeams system or a Teams machine, and also having ensured that the supplier has declared that sales in their return. So what we're seeing this is KRA passing on the mandate for ensuring compliance onto the taxpayer. And for some of this, it's a bit irregular in that, especially when you have many suppliers, how do you now go about ensuring that all your suppliers have declared the sales that they have made to you in their monthly returns? On VAT, a welcome relief is that the period for which you can claim refund for VAT on bad debts has now been expanded to 10 years. Previously, it was you had to wait for at least 3 years. Then, have a 1-year window for which you could claim that refund, but this now has been expanded from 4 to 10 years. Another one that has also been talked a lot is VAT on compensation of. So when your insurance provider compensates you on a loss, if you had claimed input VAT on the purchase of that asset that had been insured, then that compensation will also now have to attract VAT. So this is not applicable to all persons. This will only be applicable to people who had claimed input VAT on the purchase of that asset that had been insured. For those of us who provide taxable services, especially to non-resident customers and clients, a welcome relief is that these services have now reverted to zero-rated status, effective 1st of this month. And a lot of discussions have gone around this, including petition to the High Court when these were declared taxable through last year's VAT Act. So yes, just to align Kenya to international best practice, this has now reverted to zero-rated, meaning for suppliers of these services can now claim all the input VAT that they have incurred on purchases. VAT registration for digital service providers. Clarification has been brought in that you're now not required, if you're a provider of these digital services, you're not required to meet the 5 million registration threshold for you to register this for VAT. So any player within this space is now required to register for VAT. And I guess now, since VAT is expanding from out of our borders, record keeping requirement is no longer. So previously, VAT Act required that all records had to be maintained in Kenya, and especially now with people embracing technology and cloud servers and such storage facilities, this is a welcome relief in that your record keeping does not necessarily have to be physically done within Kenya. Like my colleague Winnie had mentioned, VAT on petroleum products, one of the contentious issues, especially what has also, I guess, taken the petition to the High Court. This effective last week on Friday have shot up to 16%, notwithstanding the conservatory orders that were issued by the High Court. And what we're expecting to see is the knock-on effect of fuel prices affect, I think, all parts of industry, especially for production and transport. So we're yet to see how this is going to affect, and probably what we're going to see is increase in prices for a number of goods. But hopefully, like Winnie mentioned, we're still waiting to see what the courts are going to direct on this. But I think probably maybe also another issue that is not coming out is that so long as Kenya needed IMF support to balance their budget, it was always expected that full VAT on petroleum products was going to come in, regardless of which government was in office. And probably maybe the surprise that came to us is that the IMF allowed for zero rating of LPG. And it is our hope that the producers are actually going to pass on this reduction of price by zero rating of this product to the consumer. Maybe another relief also around this is on the bioethanol vapor stoves. Now, earlier this morning, we were discussing with my boss, and he was telling me he's never heard of this. And I was telling him that is probably because he's not the consumer of these products, and he's not the target market, and maybe that's why he's never heard of the BEV stoves. And maybe one of the products in this space and not marketing them would be the cocoa stoves. I don't know if you've seen them, and they're quite cheap, especially for people who used to use charcoal or makaa burners and the kerosene stoves. This fuel has proven to be quite economical, and I guess like also how their marketing is, it's a clean fuel. So this is also a welcome relief in that both the stoves and the liquid used to fire them up is now going to be zero rated. Also in the area of cleaner consumption, and probably, I don't know if this is also going to maybe plug the issue of petrol being taxed at 16%. Kenya is trying to embrace green transportation. And so towards this end, electric bicycles, electric motorcycles, and buses are now going to be zero rated. So if you're importing this or you're producing this within the country, and we've seen quite a number of players entering this industry, these are going to be zero rated going forward. And probably also now to support this further, also solar and lithium ion batteries are also now going to be zero rated effective 1st of January, sorry, 1st of July of this month. And maybe especially on the area of electric bicycles, probably now we now need to see the government putting in on better cycling lanes or roads that can really accommodate people to be able to take up cycling. Also to boost, I think, Sakaja's plan within the school feeding program, supplies by any entity recognized by the CS for education. So supplies to that school feeding program and supplies by the school feeding program are now going to be exempt. And also in the medical area, for specialized hospitals, construction of this, if you're building at least a 50-bed capacity, taxable inputs or goods going into that construction are now going to be exempt. This has been reduced from previously 100-bed capacity to 50-bed capacity. And the idea behind this is to hopefully see more people putting up such hospitals. And so finally on VAT, there was a supply of maize flour. There was quite a lot of talk, and maybe just to put a pointer, this was a cleanup of the act in that you found that maize flour was contained both in the first schedule and second schedule. So just to clean it up, this has been clarified that these are purely zero rated. So yes, inputs for raw materials for manufacture of animal feeds. This is also zero rated. And tea and coffee locally purchased for purposes of value addition before exportation, subject to approval by Commissioner General, will also be zero rated. And I guess something else we're discussing around this, on a lot of this newly zero rated items, whenever you see that subject to approval for commissioner, that really becomes a hurdle in that for a number of clients who have tried to make applications to the commissioner, they're not always that forthcoming. And some of the times, even if they do come, that approval process takes anywhere from 3 to 6 months. So probably maybe what we hope is that this process should be made smoother. And then another clarification is that inbound international sea freight offered by a registered person is also now going to be zero rated. And then finally, we'd like to highlight locally assembled phones are now going to be zero rated. And I think it was the hope that probably government was trying to attract the likes of Samsung and maybe iPhone. But for now, we'll have to be content with the likes of the Chinese manufacturers such as Itel. But hopefully this will also boost the manufacturing scene and hopefully make phones cheaper within the country. So ladies and gentlemen, that is it from me. At this point, I'd like to invite Samuel, who will take over and take us through the other taxes and the procedural changes from the Finance Act.
Thanks, Mbiki. But just before we go there, Mbiki, we are seeing fuel prices went up on Saturday, and EPRA just disregarded the conservatory orders which were given by the court on Friday. And I'm still seeing several cars on the road. What do you think is happening? Is the government using the number of cars on the road to assume that they can easily collect 52 billion as anticipated? Do you think they'll achieve their target?
It might seem so. Going back to my economics class, probably this needs to be added to goods which are called inelastic, because it seems that for Kenyans, this price increase is not really affecting the consumption, but maybe not just for the car side. I guess now when it comes to petrol being used as an input for the process of manufacturing, the supply chain through transportation, that is probably the area that Kenyans are going to be hardest hit. And maybe just a liner, for those of you who used to shy away from using V-Power, this is proof to you that you could have afforded it all along.
Yeah, okay, so before I go tackle, you mentioned that in the first place is to target all landlords, and why would they? And in my opinion, 10% is still a very low rate compared to if you do all the accounts. Do you think again reducing the level of MRI
I guess maybe what they're hoping for is like the direction they took with TOT. When the rate was reduced, quite a number of taxpayers jumped into this regime. And then when they felt that now we have a substantial number, they reduced the threshold. So probably this is their strategy, just to get a few more landlords coming into this, because like I mentioned, it still didn't serve KRA's purposes, in that they were not able to achieve the numbers that they were hoping for. So probably maybe that's the direction that the commissioner is heading.
Thank you, Winnie. Thank you, Vicky. And members, let's just look at excise duty and ask ourselves, when or why did excise duty become like an annual, revised on an annual basis? And simply what I can say is because government realized that it can no longer continue charging, increasing our VAT, or they had exhausted the products that they were charging VAT. And also in terms of corporation tax, they had reached a point where the elasticity, as an economist like Mbiki was saying, reached a level where they could not expand it any longer. But just looking at what has been shared with us in the Finance Act 2023 is a very good news to some extent, and also not very good news. One of the good news is that they have repealed the section 10, where it was giving the commissioner the mandate for annual inflationary adjustment. And we could see that excise duty kept on being increasing on an annual basis based on inflation. And remember, who determines the inflation that they use? It is Treasury. Treasury uses its own numbers to come with inflation rate, and they will use this to make the adjustments. Excise duty stamps offense has been enhanced, penalty of 5 million. And remember, this is just to align the same with the Excise Duty Act and EGMS regulation, which give the same amount from 5 million at around 5 million. This is just to make sure that people who deal with excisable goods do not use fake stamps and do not sell their products without actually using the stamps. In the Finance Bill 2023, we had seen an attempt to introduce articles of plastics which are both local and imported at a duty rate of 15%. And now we are seeing that after public participation, which roughly has been the most, we've seen the most traction in terms of public participation this year, with almost 2,000 submissions being made to the Committee of Finance and Public and National Budget. And we are seeing that they actually dropped the intention to charge excise duty on local plastic, and they only left it with imported plastic. Same to imported pasta and sugar confectionery will now be subject to additional excise duty. Remember, this excise duty have always been introduced on sugar confectionery, even in Finance Act 2021 and 2022. There was an attempt to introduce imported pasta, but they realized that it will bring uncompetitiveness to the local manufacturers of pasta who export their pasta to Uganda and Tanzania. In terms of excise duty changes in betting, lottery, and gaming industry, I saw a question where somebody was asking the practicability of payment of excise duty within 24 hours. Remember, on other business, payment of withholding tax will be done within 5 days, but on excise duty on betting, lottery, and gaming, it will be done within 24 hours. Currently, withholding tax in this particular industry is done on a daily basis at the close of business. That is at midnight. Then 1 a.m. the payments are done to KRA. And I'm looking at this and just saying the platform is already there for betting, gaming, and lottery industry. So it will not be very difficult for KRA to implement this. Increase in excise duty, again on betting, gaming. There was an intention to increase this from 7.5% to 20%, but we are seeing after public participation, this was reduced from 20% to 12.5%. So that became effective on 1st of July. But now because of the conservatory order, this will become effective depending on the ruling of today. Fees charged, excise fees charged on alcohol, betting, gaming, lottery, and pricing competition advertising. When you advertise in this industry and advertise with one of the local media stations, then the cost of advertising will increase by excise duty for around 15%. Going forward, imported fish, initially the idea was to charge excise duty on at 20%. But one of the TV programs I was seeing, a member from Nyanza was very vocal on this, saying that they actually do not have enough supply of fish from Lake Victoria, or Lake Turkana, or anywhere. So imposing 20% will be very punitive, and he must have been listened to. That's why they reduced it to 10%. Imported sugar, excluding imported sugar purchased by a registered pharmaceutical manufacturer. And this has been charged excise duty of 5 shillings per kilo. And then what I'm seeing here is that government of Kenya has shown inability to present a coherent taxation policy. And the reason why I'm saying this is that on one hand, we are seeing in the budget, they have dedicated 270 million to expand sugar production. and yet they are saying, let's introduce 5 shillings per kilo excise duty on imported sugar, so that because sugar production is driving up the prevalence of diabetes in our households. So it is, you're saying it is causing diabetes and so increased duty, but you are pumping in 270 million on the other hand to increase production. Imported cement, excise duty is higher of 10% or Kenya shillings, 1.5 per kg, whichever is higher. Imported furniture, this will exclude furniture originating from East Africa Community, or that those that meet East Africa Community rules of origin, where excise duty has been increased at 30%. Imported cellular phones, the likes of Nokia, Samsung, Tecno, and iPhones will be charged an extra 10% in terms of duty. But ITEL, which will be manufactured locally at Konza City, will definitely not attract 10%, so there'll be 10% probably cheaper if you remove excise duty. Imported paints, varnishes, and that one you're seeing on the screen, rate has been increased to 25%. Finance bill had introduced it had proposed a rate of 15%, but you can see an increase of 10% to finalize it at 25%. Imported paper and paperboard 25%, and imported cartons and boxes, just to protect local manufacturers, at 25%. At times, the government tells us that the intention of introducing excise duty is how to increase excise duties to protect local manufacturers. But if you do not support the local manufacturers, then you still find an issue with the local manufacturers, finding it so difficult or more expensive to even manufacture what we are trying to protect them. But we give benefit of doubt to the government. Members, participants in today's webinar, I just wanted to take you through the East Africa Community Gazette. It is not part of the Finance Act 2023, but I just wanted you to note the following: that on 30th of June, the Gazette notice was released, and the following items will attract or have started attracting duty at 35%. So television set, if you plan to upgrade your television set, please note duty has increased from 25 to 35. And second-hand cars, I will talk about it. Other products are as shown on the screen, which includes beans, sweet corn, tomatoes, and peas. Most of these are imported. I've also seen Kenyans importing onions from Ethiopia, and we were at one time consuming that at Wakulima Market. Tiles and assorted steel products, duty is at 35%, and yet we are saying affordable housing should be affordable. But if we import all this, then duty has been increased. Worn items and clothes, this is what we call mitumba clothes. What majority of Kenyans depend on, duty has been increased. Trailers and semi-trailers. LPG cylinder, Kenya and Uganda have applied for a stay of attracting duty at 35. Remember where you sit. We were expecting that with finance bill, we will start buying cylinders at 600 shillings. So this negates the promise of this particular government, that what we thought gas will be at 600, clarification came that it is LPG and not gas. Now with the introduction of 35%, from 0% to 35%, and that tells you that LPG cylinder will never cost 600 shillings. Let's just forget about it. Imported furniture, plywood, iron, and steel reinforcement bars, we are seeing on one hand an increase of excise duty and also an increase of custom duty at 35. Baby diapers, this is a cold weather, please plan yourself. It is imperative for you to know that baby diapers duty has been increased to 35% among others. Let's go back to Finance Act 2023 and we look at Tax Procedures Act. So Mbiki has just created a foundation on this discussion in terms of electronic tax invoice management system. And what I can tell you and I'm aware of is KRA is in the plans of changing or taking us to another platform from iTax, to what they are calling a better accommodative and user-friendly platform. And I know most of the IT people related to iTax have been taken for trainings even abroad, just to benchmark on where we can copy and paste, because we are good at that in this particular country. We have seen a repeal of tax abandonment powers, where KRA thinks that that tax will not be collectible, and they just abandon collection of taxes. So those powers have been repealed. So any assessment that is not resolved either by a taxpayer or KRA, just know one day KRA will come and collect the taxes if you do not object to that. Repeal of waiver provision and introduction of a limited tax amnesty on penalty, interest, and fines. Please remember, Tax Procedures Act gives you a right to apply for waiver of penalty and interest, but that has now been repealed, and they are saying in case you have any penalty and interest on iTax now, and yet you had paid the principal tax by 31st of December 2022, then you're going to get an automatic amnesty on the penalty and interest. But as we speak, you have not paid the principal, then you need to apply to the commissioner, agree on a payment plan, and as long as you pay this principal tax by 30th of June 2024, then you're going to receive penalty and interest. KRA of late have been sending, and this they attempted before 30th of June, sending letters to taxpayer telling them that they have agreed internally that they will be going to, you pay 60% of the penalty and interest existing in your system, and then they'll give you waiver of 40%, and we're just supposed to notify you that they have objected your objection because it was not validly lodged. But what you are seeing now is taxpayers will have 7 more days after being notified by the commissioner of an invalid objection just to submit additional documents to validate an objection. In terms of exemption from withholding VAT, we're seeing the current provision gave registered manufacturers with an investment of at least 3 billion in preceding 3 years. From the enactment, that was the previous enactment of the act, that was in 2015, but they have changed this by removing enactment of this act, changing the wording to from 1st July 2023. So if you had invested 3 billion before 1st July 2022, then you can actually apply for exemption of withholding VAT. Good house there, but let's talk about rental income tax agent, and commissioner has been given power to revoke or appoint anyone as an agent to collect withholding rental income and pay it directly to KRA effective 1st of July. I talked about data management and reporting system. This is what they are looking at. And all this regulation related to iTax or the new data management and reporting system are going to be effective on 1st of September 2023, because I'm expecting regulations to come about before then. And one of the issues we are looking at is, and Vicky alluded to this, is if you have an invoice that has not gone through Teams or eTeams, will it be allowed for tax purpose? So this will be covered in the regulation, and I'd find it very unrealistic for a petty cash to be expected to go through eTeams or Teams. So all this will be covered there. So non-compliance of electronic tax system, we are seeing them saying that previously penalty was 100,000, but now it will be 2 times the tax due of what has not been paid. In terms of miscellaneous fees and levies act, there's an introduction of export and investment promotion levy on certain specific imported goods for home use. This is an export and investment levy for goods which are imported into the country. And the whole intention for this is just to boost manufacturing, to boost, to promote export. Of course, you boost manufacturing, promote export, you create jobs, you create or boost investments. But any goods from East Africa community will definitely be exempted. In the Finance Bill 2023, Export and Investment Promotion Levy Charge on cement clinker, iron, steel, and bars was at 10%, and this is one of the contentious issues. We were making submissions on 10% only for Parliament to come approve 17.5%. So this is an increase of 7.5% against what was tabled to Wanjiku to make submissions on, but they have retained the rate of 10% on kraft paper and paperboard and sacks and bags. In terms of other items like IDF, RDL, we are seeing the rates have now been harmonized and lower rates have been adopted. What do I mean by this? We've seen a reduction on IDF from 3.5 to 2.5, and we've seen a reduction of RDL from 2 to 1.5 for goods imported for home use, because RDL is specifically used for home use, charged for goods used for home use. Now, elimination of the import declaration fees of 1.5, because this was a preferential rate given what we call a ESC, duty remission scheme. It has been replaced with a unified rate of 2.5. In terms of Miscellaneous Act, sit down, relax, let's discuss this. You and me, we are affected by this, and in a big way. Why am I saying this? The finance bill had proposed that depending on your salary, the maximum you're going to pay is 2,500. And of course, there were benefits to this. One, the contributor will have used the amount to finance purchase of a home. Employees, who is you and me, who is employed earning a salary, will have been entitled to claim our contribution. In case you feel you don't need these houses in Gara or wherever they are being constructed, you'll have been given an opportunity to claim your contribution, but not your employer's contribution. And secondly, the contribution will have earned a form of interest accruing to employees. So we made noise. We really made noise. And everyone was not doubting why we are paying the 3%. We were doubting the capacity of government to actually use this money for the right purpose. Now, when this matter, our MPs of the Committee of Finance and National Planning went to Naivasha, I think Naivasha provided them a very conducive environment just to change this and say, now let's remove that. They have made a lot of noise. Let's reduce the rate of 1.5. And actually now surcharged it, remove it from a fund into a levy, aka a tax of 1.5 on your gross salary for each employee and each employer. Now, this comes with certain repercussions. One, there is no cap. So depending on how much you pay, you will pay 1.5%. And this is one of the biggest contentious issues, even in court today. Secondly, this money will go into a consolidated fund and account in Parliament, unless in Central Bank, unless this is ring-fenced. Government can use this tax to pay debt if at all we owe anyone anything as debt in this particular country. And this is where we are saying it became worse. And I'm wondering, did we really have to make all this noise? But it is important that we made this news. They knew we were not interested in it. As I try and finish, let me ask you a question. The picture on your left, is this where our problem started? Because when a cabinet secretary in charge of Treasury said Japan has borrowed 238% of its GDP, US 107%, Kenya is only 57%. All countries have developed because of borrowing. I do not dispute. But were we trying to become Japan? Were we trying to become US? I was just joking with Mbeki and Winnie and telling them there's research which was done one day where some researchers and economists wanted to find out when will Kenya ever reach or be in the same status with Japan. And data was fed into a computer. After 6 days, the motherboard collapsed Actually, they were just seeing smoke on the motherboard. That tells you we will never be Japan. So this comparison, in my opinion, is where the problem started. Secondly, those who know history very well know that in 1968, Kenya actually gave a loan to Singapore to develop. At one point, it is said Kenya and Singapore were in the same status, were in the same WhatsApp group. But where are we now? They are actually 30 years ahead of us. And unless they stop doing what they're doing for 30 years is when we're going to reach a Singapore. So trying to tell us one day we want to be like Singapore, good ideas, but are we being realistic? On your right, you're seeing just what the government has borrowed at 1.2 trillion, though CBK is giving us this figure at 900 billion. If you count how much money has just come into this country, and especially in the month of May, you're seeing 3 billion, and in the month of June, there's 220 billion borrowed from domestic market and also from IMF, 162 billion, tells you where we're heading to. Parting shots. Have you known, or do you know that our Auditor General said that there is no record available to show our debt position? So again, is Okia Omtata right that this country has overpaid its taxes? Is Maina Wanjigi right that this country has no debt to pay? Because if as a country, we have no record to show exactly how much we pay, then what is this that we are paying? Are we really paying China for SGR for money that does not exist? Again, as a country, we have already crossed the 10 trillion mark as the 30th of June 2023. We were at, that is on 1st of July, we were at 10.02 trillion. And this shows you the appetite we have in terms of borrowing. And probably you might want to understand why the government has been pushing for the implementation of Finance Act 2023. CBK, early last week, just increased by 100 basis the rate of deemed interest, saying inflation has gone up since April. But June data by Kenya National Bureau of Statistics released a week later showed that inflation was almost unchanged from May. So this is one body of government telling us inflation has increased, another body of government telling us inflation has actually remained consistent and constant. There's also news that came in that Salary Remuneration Commission decided to hike public servant salary by 14%. In my opinion, just to cushion them against levies and taxes in Finance Act 2023, painful for private sector because this only affects public servants. EPRA went against the norm and decided to increase retail prices by 8%, but decided not to effect changes of IDF and RDL with the same swiftness because the price changes are expected to come up on 14th, the new prices of fuel expected to come up on 14th of July. And I'm expecting them to tell us that the fuel we are talking about was actually imported in May. So you wait for the fuel that was imported in June for us to give you a better pricing. In fact, if you want to see lower prices. Stories again, 7 million Kenyans have been removed from CRB. President has been vocal to say that to talk to this, but talk to majority of them. They're saying this is hot air. So my question is somebody feeding our president with lies to make him look like a liar, or it is just public rhetoric which is not substantiated? If you want that car, OMG 77, please know that government has sneaked in a 35% duty on imported cars. This is by increasing it by 10%. Initially it was 25. Cars prices will definitely go up. And this is not covered in Finance Bill 2023. So I will leave you with this. I just found it is copied from a Twitter page of Mwango Capital, where interest rates were around 8.75% when I left, the president asking. And then the person who was left in charge saying, hey, there was like a problem which happened, but let me explain. Currently, we could be at 10% increase. We are actually on double digit after a very long time. We are seeing interest rates at double digit. And what does this mean? We have seen banks sending notifications and that they're going to increase interest rates on new loans. And I was just sharing with some of my colleagues that at one time I actually borrowed money at 23%. And we can see when interest rate was restricted, a lot of us went and still borrowed money. And will we be affected by the change of interest rate? So, ladies and gentlemen, up to that particular point, I will leave it for Winnie to take us through question and answer, where me and Vicky will be able to handle the same. Thank you.
Thanks, Samuel, for that wonderful clarification and presentation. So I'm going to point out some questions which the participants have raised in the chat box. One would be from Albert. Kindly clarify on amnesty, where there's no principal tax to pay, but penalties and interest have accrued. Samuel, to you.
Sorry, if you can just repeat that question.
Clarify on amnesty, where there is no principal tax to pay, but penalties and interest have accrued.
Hope you can hear me, Winnie. It is now if interest, let me clarify, if by 31st of December 2022, you had penalty and interest on the system and the entire interest had been entire principal amount had been paid, then you will automatically get an amnesty on the penalty and interest. But if there was a principal amount, then you will have to have a conversation with your relationship manager, who is in charge of your PIN, and agree on a payment plan on the same. So, and you'll be forced to pay these taxes by 30th of June 2024 for you to qualify for the amnesty that has been introduced under the Finance Act 2023. Over to you.
Thanks, Samuel. One more question from Waidira. Affordable housing levy for secondary income. Will the housing levy apply? Will the housing levy be taxed or night tax as of today? The levy is still capped at 5,000 for both employer and employees. Sorry, Samuel, let me take that again. Another question, affordable housing levy, to clarify whether these will apply for secondary incomes, and will the housing levy be taxed? And on night tax as of today, the levy is still capped at 5,000 shillings for both employer and employee.
Thanks, Winnie. One thing I want just to bring to the attention of every person earning a salary, it talks about gross salary. It's not talking about primary or secondary. And I listened to the chair of Finance and National Planning, who is a fellow CPA, Kimani Kuria. He was very candid. He knows people earn salaries everywhere. And he knows people, if they leave it at basic salary, somebody will say basic salary is 5,000, but house allowance and other benefits. They'll create other form of benefits to be given. My understanding of this, because I was at the submissions 3 times at Serena, and we sought clarification face to face, is they are looking at gross salary, not including the benefits like telephone, telephone and car benefit, but any other form of payment. And remember, if you have any other form of payment like bonus, does not qualify as a salary. Bonus is based on performance, so it doesn't qualify. And it also, that does not mean you start paying bonuses every month. It will look like you are actually benefiting on that bonus on a monthly basis, because we accountants can be very creative in terms of some of these things. And you really need to justify why you have to pay a bonus every month or a commission every month. So it is on salary you earn. So company A pays you salary of 10,000, company B pays you secondary salary, even company B will have to deduct 1.5% of that particular amount. Winnie? Thank you, Vicky, for reminding me. The 5K cap has been removed. So if you have a salary of 100,000, then 1.5% of that is it 1,500 of? Yes. If you have 1 million, it is 15,000. And remember, even if you pay 15,000, you are not assured of a house. That's the bad news I have for you today.
Thanks, Samuel. Another question, what is the effective date of excess duty on financial services for banks and financial institutions coming into effect?
That is on 1st July 2023.
All right. Another question would be, please clarify on filing and remitting both withholding tax and withholding VAT within 5 days. Is it applicable to all entities or only to content creators in the industry?
Good question. This is applicable to all taxpayers, including someone. Today, if I pay a content creator 25,000 shillings, I'm mandated by KRA to deduct withholding tax and pay from today. One thing you need to know, and if we let KRA, and I was listening to one of their webinars today morning, and they were saying that in as much as the Act says a point of deduction, what is a point of deduction? Point of deduction, as clarified by the case of Fintel, Kenya Limited versus KRA, is at the point in which you enjoy the benefit. So if you book an invoice today, then you are supposed to pay, today being a Tuesday, I'm supposed to pay withholding tax and withholding VAT. For instance, it is GT because we are appointed agents, VAT appointed agents. Our accountant will be forced to pay, will be given half Wednesday, Thursday, Friday. Saturday and Sunday is not a working day. So it will be Wednesday, Thursday, Friday, Monday and Tuesday. By Tuesday, she has to pay withholding tax and withholding VAT, depending on the outcome of the ruling today.
Thank you. Can just take a few questions. Does housing levy apply to sales commissions and bonuses?
To me, I will look at it this way. It's not your salary, so it should not. And we as taxpayers, we should be ready to fight this. What will be applicable, in my opinion, on sales commission is pay as you earn. But KRA might come, the way KRA thinks. They have their own rules and come and say, since it was deducted pay as you earn, was it a salary? But I must justify that, in my opinion, it is a commission, and we should be ready to fight for this. And these are some of the clarification we need to sort out, and we are fighting because there's still a lot of ambiguity in as much as what constitutes your gross monthly salary. Remember, the word that has been used there is gross monthly salary. So if I get a one-off commission, is it a monthly salary? If I get a commission, because there are people who actually get commissions on top of their salaries. When you employed me, you said my salary is this, my house allowance is this, that's my gross income. And that is what, in my opinion, should be charged National Housing Development Fund at 1.5%.
Thank you for that, Samuel. Majority of the questions under Biki's session, he was able to respond through the chat box. Unless there's any other particular question from the participants, we can close the session to an end. Just to recap on what I mentioned, we already shared the alert to your emails.